From 1965 to 2022, Warren Buffett's Berkshire Hathaway achieved a constant annual growth rate of 19.8%, which is double of the 9.9% CAGR the S&P has done in the same time frame. So, if you zoom out to their all-time returns, Berkshire has achieved a total of 45,632.06% compared to the index, which has returned 3,127.57%. However, you might say this is unfair because the S&P has had a shorter track record than Berkshire does. So instead, let's say you invested $100 into the S&P 500 back in 1965 and do not add any more money to this position. In 2022, your investment would have grown to $21,720, which is a great place to end up considering you only put in $100. However, let's see what would have happened if you had put the same money into Berkshire. If you had done the same, your money would have grown to $2,965,095.11, which is astonishing considering you started with $100. So you might be wondering, why am I telling you this? In this video, I'll be diving into one key metric that dictates the return of a stock and why you should understand how it works for you to get outsized returns in your portfolio. So please sit back and enjoy the video. Don't forget to subscribe to my channel and tap the bell notification to keep up with future uploads. Now, let's get into it. Charlie Munger, who was Warren's right-hand man, was famously known for changing Buffett's investment philosophy. They changed from buying fair businesses at wonderful prices to buying wonderful businesses at fair prices. Charlie once said, "Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you end up with one fine result." The metric that Charlie was talking about here is ROCE, which stands for Return on Capital Employed. It is also commonly known as ROIC, which is Return on Invested Capital. Now, what this financial ratio essentially measures is how efficiently a business can generate profits from its existing capital. Now, the reason this metric is very important is because this is what drives the stock returns over the long term. Listen to what these super investors have to say about the same metric.
It's going to be 40 years long. You can either buy Company A or Company B. Company A makes a 20% return on capital. Company B makes a 10% return on capital. Just to save us a lot of sort of strenuous arithmetic, neither of them pays a dividend. They both invest all of their profits back into the business at the same rate of return. Okay, who wants to own A? This is a show of hands thing. B, anybody? Anyone want B? No, good. You've all been listening. Oh, there's a man with B over there. We've got a man with B. Well done, sir. Yeah. Not even my regular straight man. Good. Now, I haven't, of course, as ever with any question I ever pose, it's always completely unfair because I haven't given you enough information to answer the question. You need to know what value you buy it and sell it at, don't you? So here's what happens with these two shares. Not unreasonably, A, the 20% returner, is priced, the shares are priced at 4 times its book value. Whereas B, the 10% returner, is only trading at 2 times book value when you buy them. Okay, who wants A? Anyone want to join this gentleman on B? Can't see any. Oh, a couple of B's over there. Well done, well done. Yeah, good. Okay, still haven't got enough information. How about when you come to sell them? Okay, when you come to sell them, it's all gone horribly wrong. If you bought A on 4 times book, the rating's halved to 2 times book. And that's a bit of bad luck, isn't it, really? It happens, I suppose. B, you've done very well. It's gone from 2 times book to 4 times book. The rating has doubled in the time that you sell it. Okay, who wants A now? Who wants B now? No, still a couple of B. There's your answer. If that was the portfolio the choice facing you, A, with a 20% return on capital, bought on 4 times book and sold on 2 times book would give you a share price return of 18% per annum in compound annual growth. B, with a 10% return, even though you doubled the rating on which you bought it when you sold it, would only get to a 12% annual return in terms of share price. If you are going to be a long-term investor, and I hope you all realise by now we are on your behalf, whether or not you are investing in a good company that makes high returns and can reinvest in its business at something like those high returns is the single biggest determinant of the outcome.
And the first one you see says the bottom line of all investing is rate of return. And we believe that's in our DNA. And so everything we do about selecting an investment goes to the issue about how can we best understand what the rate of return opportunity is in that investment. We believe that whatever return the business has itself will be reflected in the share price over a period of time. We do some simple little arithmetic to reinforce that. Then when we find a business, we really focus on 3 issues, and in the shorthand, we've all talked about that, called the 3-legged stool. And so the first leg is understanding exactly what the nature of the business is and what kind of returns on the owner's capital does it produce. And then we want to see if it has the ability to do that for a long time, if the runway is wide and long, we say. So what's causing that above average rate of return to exist? What's going on? What's unusual about that business? So the second leg that we look at is the people who run the business. And we're very focused on the skill level of the people who run the business and look at their record and whatnot. But we also want to know that they're acting in the best interest of all shareholders. That is, we see that what happens in the business happens to us on a per share basis. And then the last leg of it is the issue of reinvestment. So we examine how it is they have reinvested free cash flow in the past, what the outcomes have been, and they rarely break those out, by the way. We have to do our own work. And then what the opportunity for reinvestment going forward is, because the fact that they can reinvest all of their free cash flow to earn above average returns enhances our compounding effect. And that's what we're after at the end of the day. We want to compound our shareholders, our clients' capital at an above average rate while assuming a below average level of risk. And the below average level of risk piece for us has got nothing to do with volatility. It has to do with the fact that the businesses we own on average have more returns on capital, have higher growth rates, have stronger balance sheets, and very frequently have lower valuations than the market at the time we purchased them. So on their face, they have less risk than the market, than average. So great example of that would be a company like MasterCard or Visa. They're earning returns on capital that, as we say, you could cut in half twice and it would still be above average for an American business. So something extraordinary is going on there.
Right.
And the company does not talk about what that is. They never talk about it. We don't talk about it, but we spend a lot of time thinking about it, trying to understand what it is, whether or not it's likely to continue.
Now, as demonstrated by our super investors Terry Smith and Chuck Arkwright, the ROCE is what determines the constant annual growth rate of a business. Even if you are buying that business at a slightly higher valuation than the market, there is strong correlation between the return on capital employed and the return on the stock price. Now, here is a list of different businesses and how they have done over the past 10 years. I will be comparing their return on capital employed compared to the return on the stock price. So our first example here is Costco. Costco over the last 10 years has had an average annual return on their stock of 23.01%. Now, if you look at their ROCE since 2014 all the way through to 2023, it has consistently been above 20%. There were 2 years where it did dip below this number. However, if you collect the average, it is above 20%. The next example here is Google. Google has had an average annual return of 22.51%, and their ROCE has been 14, 15s, 13s, and then it shot up into the 20% over the last 3 years. The next example is one of Terry Smith's favorite investments, Microsoft. Microsoft since 2014 has had consistently above 20% returns. It dipped below to the 16s, however, it re-accelerated and climbed back up to even hit 30% in 2022, while its stock price has returned an average of 29.65% per year. And the final example we have here is Visa. Visa since 2014 has had returns on capital employed above 20% over the past 10 years, and its stock price has returned 18.34% per year. Now, all of these companies beat the S&P 500, which had returned 10.77% per year over the same time frame. That wraps up the video for today, guys. I hope you really take on this concept of return on capital employed and really apply it to your investment analysis. We learn a lot from these super investors today, and they pass on a wealth of knowledge. Other important fundamentals to also look out for include the free cash flow yield, free cash flow growth, revenue growth, and earnings per share growth. However, if you guys would like me to make a future video regarding any of these, please drop it down in the comments below. And thank you guys for watching, and I will see you in the next one.